And let's start off with BlackRock, because BlackRock is the world's largest investment management firm. It's US based. In fact, it has its headquarters on East 52nd Street. For one reason or another, I've sometimes stayed at the Palace, New York Palace in Midtown Manhattan, and the BlackRock head office is across the road. There's a Starbucks at the bottom.
That's okay, very convenient.
Two birds with one stone.
Yeah.
In any event, market capitalization $60.49 billion. So that's pretty sizable.
Yep.
It's not as big as some of the big US banks, but remember, this is a niche player. And some of the banks, let me say, also have asset management divisions.
Yes.
In fact, most of them do. But what we're talking about here is companies that are rather more focused on that.
Asset managers.
Price to earnings ratio, fairly standard for that market at 19.83, and a fair dividend yield, 2.46%. But remember, this business isn't all that old, but they bought Barclays' iShares business. So they've got an operation in the ETF index tracking business as well as actively managed funds.
And they bought some business from Merrill Lynch, so they were very acquisitive when they started the business, only in 1988. I actually thought this business ran for a lot longer, so fairly new. Not the biggest company, but what is massive is the assets under management. So it's updated. It's almost $5 trillion now that they have.
$5 trillion.
That's 66 trillion rand. I mean, it boggles the mind. They take in about $10 billion inflow a month on average. That's what they did over the last year.
Employer-based contributions to 401k plans and people who've got debit order savings policies and so on. Yeah.
So their platforms and their distribution is so entrenched that they're in every facet of a lot of big institutional money in the US. Hence the numbers we're talking about there.
So the founder, Larry Fink, built the business, and it was initially quite heavily focused on bonds and management of bonds. Interesting one, because bonds have been quite a tricky asset class of late. But then they started getting into equities, and the move to buy Barclays' global investor business was quite masterful. Yeah. It should be noted that was just the first in a long string of very bad decisions by Barclays with regard to selling things, the most recent of which is to sell Barclays Africa, nudge, nudge, wink, wink, at a very bad price. So anyway, Barclays is busy scoring own goals for days. But they then get into this as well, so they're getting the benefit of those customers that want to buy like exchange-traded funds as well as the actively managed funds that they offer internally.
Yeah. I think they were one of the first to offer those kind of multi-asset offerings, so you could have your bonds, your cash, and your equities all in one and choose from it in that regard. So they would pioneer that space. Now,
I've actually owned these shares before, which is interesting because I thought, look, they're going to aggregate assets, they're going to do well. You can see there's the share chart over 5 years. Thanks, the director just reminded me to show people there. So you can see it does well. It goes from $150 all the way to like $400. It's been a bit sidewaysy since then, but that's because the whole market's been sidewaysy. But if you track this share chart and put the S&P 500 over it, you can see it's very similar. And that sort of makes sense because when the market's rising, then it takes their assets from 4 trillion to 5 trillion, and then they do well.
Well, that's the thing about these companies is they've got this built-in inflation. When in markets are rising, their fees automatically rise without them doing anything. So, if you want to buy BlackRock, it's really your view on where the market is going in the foreseeable future. That's how I see this.
Which, in a way, is what's going to happen to the other stocks in your portfolio as well.
Yeah, to a degree.
But there was a second reason why I actually sold mine, and then it was because it dawned on me, like I don't know why it needed to dawn on me at my age, was that I own like a big chunk of an asset management company anyway, my employer, Vestact. So what do I want to then replicate
concentrated in that regard?
It's like being in the construction business and then going into your equities portfolio and buying shares of Murray & Roberts. It's like, why? What are you doing?
So your net wealth is very concentrated in asset management already without having to add to it with another holding.
So that's why it's not hot for me. But do you think for people going into global markets, it's an interesting one?
It is interesting, but I think there are some headwinds there. Revenues are coming down a bit, profits are coming down, as we spoke about the pressure on these fees.
Because their big competitors in the ETF game would be people like Vanguard and Fidelity and others that are collecting lots of more money, perhaps.
And becoming more competitive. So how are they going to stay ahead of the curve in that regard? 19, 20 PE, you're paying a lot for probably quite pedestrian earnings growth there. So
we're going to go not hot.
Not hot for me,
And then for me, as I indicated, not hot for a specific reason. Okay.